You must have heard mutual fund sahi hai millions of times, but is it always the right answer for your investment needs? You have the resources, but are you undecided on which investment vehicles to choose? In this video, I will compare these five investment vehicles, that is mutual funds, ETFs, SIFs, PMS, and AIFs, with each other on 11 parameters to find out the best one. We will start by locating these investment vehicles in the entire financial ecosystem, and then we will move on to the comparison. So to locate these investment vehicles, we'll go through three graphs. This is the first graph of the three. It shows the hierarchy of the broader financial system. So the financial system can be divided into two categories: financial markets and financial institutions. Financial markets have money markets and capital markets, whereas financial institutions have depository institutions, contractual saving institutions, and investment intermediaries. The capital markets have primary markets and secondary markets. Primary markets are for IPOs, and secondary markets contains equity markets, debt markets, derivative markets, commodity markets, and currency markets, and finally the real estate markets. This is the second graph, and it shows the investment management landscape. It contains investment vehicles with underlying investment options in various asset classes. There are numerous factors like investment strategy, risk profile, investment goals, time horizon, etc., which have significant impact on the entire investment management landscape. Let's dig deep into the investment vehicles and see the various types of vehicles available in India. So, this is the third graph and it shows various investment vehicles in India. So the investment vehicles can be divided as direct investments, pooled investment vehicles, and insurance products with various with investment components. And these all can further be subdivided. In this video, we are interested in the pooled investment vehicles. It has regulated funds, sophisticated or less regulated funds, and pension funds. Under regulated funds, we have mutual funds, ETFs, and SIFs. Whereas under less regulated or sophisticated funds, we have PMS and AIFs. So these five are the investment vehicles which we are interested in this video. Now let's compare them against uh, 11 parameters. So these are the 11 parameters: average returns, investment strategy flexibility, derivatives use, regulations, minimum investment, target investors, tax efficiency, liquidity, fees, trading, and transparency. So let's start with the average returns. Average returns, as the name implies, is the parameter to measure the yearly returns in the percentage of any investment. So mutual funds, ETFs, SIFs, PMS, and AIFs. So the mutual funds, the average returns are approximately 25%. Now this is a ballpark number. Now this varies significantly depending upon the type of mutual fund. What I have done is I have taken an approximation of or an average of the top 10 mutual funds available in Indian market. This is just to give a comparison between these two. These numbers may be way off depending upon the product that you choose, but this is just to give the comparison. So the mutual funds approximately returns are 25%. ETFs have significantly less returns than mutual funds with approximately 15%. For SIF, there is no data because there is no SIF available at the moment for investment. It is something still under process. PMS and AIFs, the approximate returns are around 20%. For PMS, it's slightly greater than 20, around 21 odd percent, and as for AIF, it's slightly less than 20, around 19 odd percent. Now, along with returns, another point to note is the associated risk with each of these vehicles. Mutual funds and ETFs are considered less risky, whereas the risk increases at each step with SIFs, PMS, and AIFs. Let's move on to the next parameter, which is the investment strategy flexibility. This parameter describes the degree to which the fund manager or portfolio manager can employ diverse and dynamic investment approaches. Higher flexibility allows for more active management, concentrated bets, and the use of complex strategies. So, flexibility in mutual funds, the flexibility is lowest, whereas in AIF it is the highest. So, it clearly increases this way. The flexibility is lowest in mutual fund and highest in AIF. Let's move on to the derivative use. This indicates the extent to which the investment vehicle can utilize financial derivatives like futures and options. Derivatives can be used for hedging, that is to reduce risk, speculation, which is to aim for higher returns, or efficient portfolio management. So, in mutual funds and ETFs, the use of derivatives is only for hedging, whereas in SIF, it is a core investment tool with up to 25% allowed in derivatives. In PMS and AIF, the extensive use is possible depending upon the category of these vehicles. Let's move on to the regulation. This refers to the level of oversight and the rules imposed by a regulatory body, primarily SEBI in India, on each type of investment vehicle. Higher regulation generally implies more investor protection, standardized procedures, and stricter disclosure requirements. So, mutual fund and ETF are highly regulated, whereas SIF and PMS are moderately regulated. AIF regulation depends upon the category and it can vary from moderate to high. Moving on to the minimum investment, this is the lowest amount of money an investor needs to invest in a particular investment vehicle or product within it. So in mutual funds, the minimum is investment could be as low as rupees 500. In ETFs, it could even be lower than rupees 100. While SIF, PMS, and AIF are big ticket vehicles with 10 lakh, 50 lakhs, and 1 crore as the minimum limit for investment. Moving on to the target investors, this describes the typical investor profile or category that each investment vehicle is primarily designed for based on factors like risk appetite, financial capacity, and investment knowledge. So in mutual funds, the target investors are retail, HNI, and corporates. In ETFs, it's retail, HNI, and institutional. For SIF, target investors are mass, affluent, HNI. For PMF, it's HNI and institutional. And for AIF, the target investors are sophisticated HNI and institutional. Let's move on to the tax efficiency. This refers to how the returns generated from the investment vehicles are taxed in the hands of the investor. Tax efficiency relates to how much of the pre tax return is retained after taxes. So, mutual fund and ETFs are high tax efficient. SIF are relatively tax efficient but less than mutual fund and ETF. PMS even lesser tax efficient, and for AIF it varies by category and structure. Moving on to liquidity, this describes how easily and quickly an investor can buy or sell their investment without significantly affecting its price. Highly liquid investments can be converted to cash readily. So, in terms of liquidity, mutual funds, the liquidity is generally high, especially the top mutual funds which have very high AUM. In ETF, it's the highest. The liquidity is highest in ETF. In SIF, it's moderate to low. So is the case in PMS. And in AIF, it's the lowest. Moving on to the fees. These are the costs associated with investing in the vehicle, such as management fees, expense ratios, performance fees, and transaction costs. Mutual funds have low expense ratios, but ETFs have very low expense ratios and the least fees. SIF falls between mutual fund and PMS. In PMS, there is 2% fixed and approximately 15% of profit. So, again, these are approximation ballpark figures. They may vary a bit here and there depending upon the fund house or the category. In AIF, the fixed fee is 2% and approximately 20% of profit. So AIF, the fees is the highest. Moving on to trading, this describes how the investment units or shares are bought and sold. It affects the speed and price at which transactions occur. Real time trading offers more flexibility, while end of day NAV based trading is simpler. So let's see. In mutual fund, it's end of day NAV based. ETFs are real time on exchanges. This is the best thing about ETFs, other than the less fee and low ticket size. For SIF, end of day NAV based, and PMS and AIF, they are not traded on exchanges. And finally, the transparency. This refers to the level of information disclosed to investors about the fund's holdings, investment strategy, performance, and fees. So, in that, mutual fund, ETF, and SIF have high transparency, whereas PMS and AIF have moderate transparency. So we have analyzed all the five vehicles across these 11 parameters. Let's try to conclude what we have seen. Mutual funds and ETFs stand at more accessible and particularly for retail investors. SIFs are the new kid on the block. Their purpose is to bridge the gap between traditional mutual funds and PMS. PMS cater to high net worth individuals seeking personalized and actively managed portfolios tailored to their specific financial goals. And finally, the AIFs, they represent the less regulated and providing access to non-traditional asset classes and sophisticated investment strategies like private equity and hedge funds. So the conclusion is that there is no clear winner as such. All of these investment vehicles have their pros and cons, and the choice of investment vehicle ultimately depends on your financial situation, investment goals, risk tolerance, understanding of the products, and the amount you are willing to invest. So that is all from my side in this video. Thanks for watching it. I hope that you have liked the content. If you do, subscribe to my channel and like this video. Goodbye for now.